there's a lot of opportunities out there in the market, and we'll kind of speak to that today. But first, tell everybody who you are, what you do, and the service that you can provide for investors.
For sure. Well, I always appreciate opportunity to chat with you and always just appreciate catching up with you, Fuquan. So, based out of Pennsylvania, been around for over 20 years, and CAMA Plan's an IRA provider. We're a self-directed IRA administrator. Then he and Maggie formed the company, and there are 7,000 clients, 1.3 billion of assets. Plan remains a strong IRA provider today. Let's get into it. What is a self-directed IRA? Fuquan, the realization I had after being at CAMA Plan almost 2 years now is the best way to break it down is a self-directed IRA. It's just an IRA. And I think that people get caught up on that whole self-directed term. That's just the name that companies like CAMA Plan and others have given it. At the end of the day, it's just an IRA, but our IRAs allow investors to do is to kind of play in a different investment sandbox, so to speak. So you can invest in alternatives through a self-directed IRA like oil and gas, private real estate funds, things like that. Realizing that helps people see how they can fit this self-directed IRA into their own portfolio. And the benefit of using a self-directed IRA is just about control. And so, a common example that we like to give is imagine you have this career of professional experience and you develop all this knowledge. Unless you're, working on Wall Street and a finance person, you don't necessarily automatically have knowledge about the stock market, but you might have knowledge about something else. These are the most common allowable investments that we've seen at CAMA Plan and really across the kind of IRA and getting involved in real estate through their IRA. Lending, so that second column, also very, very powerful tool you can use inside of a self-directed IRA. It's especially attractive to real estate investors who want to own real estate outside of an IRA but still want to stay in the asset class, so they lend, or for investors who are getting older, they no longer want to get involved in real estate equity projects, so that instead they opt for lending. And then the third column, private placements. I'd say what's really attractive about this for a lot of self-directed IRA investors is you're still able to maintain that passive relationship to your IRA that you might be accustomed to if you're at a brokerage, but you're getting more of the upside. So if you're in mutual funds and things like that, and you want to have better returns or you want to invest in hard assets, owning a home inside your IRA might feel a little bit too much, but investing into a debt fund or investing into a fix and flip fund, something like that, that might feel a little bit more comfortable for you and still give you that relationship that you like, and you're not having to make sure that the property is being managed correctly, et cetera.
I have a question.
Sure.
Where are you seeing the money flow? There's always a pivot in the market when things come up, and you see investors that are heavy. Was multifamily was the thing years ago. I'm pretty sure a lot of the funds that came from IRA before 2022, a lot of it was allocated to syndications and multifamily. We're going through this global financial crisis of multifamily. I'm pretty
Yep.
sure you've heard of it unless you've been under a rock. A lot of investors are, getting away from that and going more into private mortgages, funds where they get a straight return. Where are you seeing on your end that, most of the capital is being deployed to? What's the sweet spot?
So I'd say that is the asset somewhat, but more it's about the sponsor and their track record. That's probably the key thing. The other thing is fees, a structure where fees are getting paid to the sponsor, investors are getting their money. I think that's also shifting because a lot of investors got burned and felt like the sponsor, things get out of hand because the sponsor was making money on fees. And so now I'm seeing more sponsors kind of push their fees to the end so that they're not getting their payment until after. So, in summary, what do? We are a neutral third party. We can't sell any investments or endorse any investments, which we see as a positive thing because that means that when we're talking to you about using an IRA, it's just coming from that perspective. We're only going to tell you about how an investment would work in an IRA, but we're not going to try to sell you on the investment itself because we can't. I was going to ask you, so that sort of same question that you asked me about, what do I see in terms of where the money's flowing? What are some indications that that investor might not be asking the right questions or be like really fully appreciating asking it they should know? Like, what are some signs where you think like, oh, this is going to get, if they're not careful, they might get caught up into whatever is bright and shiny as opposed to asking the right questions that they should be looking for, especially in an environment right now?
You hit it on the head last time about the sponsor. There's less questions asked about the track record, and there's more questions asked about the deal and how much I'm going to make and what do I get the payment. It's more centered around that, right? And you can tell when you speak with an experienced investor, a seasoned investor, because they want to know more about track record. They want to know more about your failures. They want to know more about your pain points. They want to hear that story. How did you overcome it? Right. They don't want to hear good. They want to hear, how did you handle that challenge? What did you do? How did you communicate? So those are more the conversations, questions that I get during my conversations with investors. The newer people who's just getting in are more concerned about the higher yield they can make, whether it's monthly payments or quarterly payments. Can you compound?
Yeah.
Everything to do with the money part and nothing to do with the sponsor, right? So that's very important that you hit that. People now, because they've been bit and they see that, the sponsor's not communicating or the person wasn't who they said they were, all it was a marketing machine. And basically they're coming to find out. So that's kind of what I see. And when they ask, is there any question that I didn't ask that I should know? That's when I started to talk about track record.
Yeah, and I
So
think questions coming in about like how did you overcome that challenge? I think good sponsors, I'll just say good sponsors do is they are a bit real and they tell about when things went wrong because seasoned investors know that things don't always go right. Even
100%.
even in like a financial environment, things don't always go well. So when it going got tough, how did you handle it? So yeah, I'm glad you touched on that.
And that brings me to my third thing is the transparent communication. That is really what sets us apart from a lot of other sponsors is, we tell the good, bad, and ugly. We're not going to sugarcoat it. We kind of give investors updates instead of once a quarter, every 3 weeks to 30 days, just some information people want to hear. It was weird because before, for me, it was people just cared about the payment and we would just call them randomly. This is before 2022, right? When everything was great. We would just call, hey, just checking on you to see if everything is all right. And it was weird for people to get a call from the sponsor just to check to see how they're doing personally, right? Most people just, as long as they got their coupon payment, they was fine. So we've always done that. And we've always looked at ways to survey it to see what are we not doing that we can do better. And right now, what we're doing is more education, because I think that is where a lot of sponsors feel also is when they first have the deal, they have all these projections, the performer, everything is great. Then once they close the deal, there's no further education on the asset, right? So you'd be surprised how many people invest in things and have no idea. It could have just came from a referral or whatever it was, but you'd be surprised because this person they know trusts you, they're going to invest with you instead of really understanding the asset that they're investing in and getting continuous education. So that's something that we're improving on this year, actually is working on more education to investors, whether it's a short 10, 15-minute video, something like that. So, again, we target just stuff in North Jersey with a defined exit strategy, which is really just to sell and put back on the market. So we look at absorption rates, we look at time things sitting on the market. It's really, I guess, within the counties that we invest in, each city has its own nuance. For example, we're in West Orange, New Jersey. We have a project there. That project would sell faster than something in Watchung, New Jersey, which is further away from the train station. Still a desirable area, but a house over $2 million may sit on the market for 6 months. Versus in the area where we're at in West Orange, more train stations, travel to New York, closer to the city, that house may sell in 2 months. So it just depends on when you're buying. So those are some of the things that we look at, profitability, turn time. And then we have our whole acquisition, planning, budget, permits, pre-construction, renovation, quality control, and then we list it for the exit. So this is kind of, our process. how value is created through disciplined execution. So this is the track record that we talked about, right? So, over 54 projects, basically we deployed 18 million and we sold for, 32 million. So this is the evolution of the MNG ground up construction, quick flips. A lot of stuff we got. We bought the land, we tore it down, we built a 5,000 square foot house, and those profits are 800,000, 600,000, sometimes $1 million on a project. But those can take 24 months. This is why we made a pivot this second quarter to doing smaller projects to increase our cash conversion cycle, so we're not too top heavy with all these massive ground up luxury projects. So that's kind of what we're doing now. And that was the reason that we just launched this fund. So here's some case studies. Basically, you can scan a QR code. It'll show you the evolution of the project from beginning to end. But we purchased this for $1,250, all in cost $1,250, and we sold it for $1,860, and it was 1 year. So this is, the type of profits that we make on these projects. This is another one, same town, all in cost 1.2. We sold for 1.6. So all in cost is holding costs, interest, everything. Kitchen sink. That's how the number on the balance sheet, and the sales price is the sales price. So this is another one. This is a smaller profit. We did an addition to this house, popped the roof, and basically added some more bedrooms. This was about a year also. Smaller profit, but still decent. So what we're currently paying investors is 12% is a $25,000 minimum. So investors who don't have a relationship with us, they get the chance to, start off with something small to see how we do with communication and everything. These are monthly payments. After the first 60 days of being in the fund, you start your distribution, and it's 12% for the year. There's no compounding, it's just straight 12% monthly payments. And that's pretty much what we have going on right now. So how it works is they review the opportunity, they subscribe to the fund. Basically, we'll have an asset lined up, and then that money will be deployed into that asset. So it's a fund, but each class is a separate property. And the protection is a UCC filing with that class. So it's clouded on a title for those investors that are in that class. So we take down a property, we renovate it, we list it to sell, investors get paid. So the term is 1 year, but they can get cashed out in less than a year. And then if we have another property, they can just roll their investment over to another property. And that's pretty much, how it works. That's simple.
Is it,
So
do they get a 1099 or a K1 at the end of the
it's a
tax year?
K1 because it's in a fund.
Okay. And
It's a K1.
is it just considered
Interest income.
interest income? Okay. And that's
Correct.
just that's the reason I'm asking is because something that for people who are researching self-directed IRAs is they find out about unrelated business income tax that can be triggered by debt in real estate. With your deal, if it's just interest income, there's no U. So
Yeah, this is
yeah,
like a pretty much
yep.
it's like that fund. So this is the capital stack. So the deals that we purchase are between 650. There may be some for 400. It's really to find one investor to fund it all. So the way we do it is we actually have approvals with these credit facilities. They're over $30 million that we have that we'll tap into. They'll give us the loan on it, but they give us a certain loan to value. And then we have to come up with the rest of the money plus first phase of construction. So example, if the acquisition was, 700,000, this lender may give us 500,000 plus 100% of the construction. But we'll have to come up with the 200,000 in the closing costs. And then that's when we reach out to investors and say, hey, we have a commitment already from this lender. We have the property under contract. We need to backfill the rest to be able to close and do first construction. So we need to raise about $350,000. We'll get probably 2 or 3 investors that will go into that specific class with that property. They'll have senior debt before them, but the capital stack still shows equity above because remember, when we finish it, we're going to sell it and make a profit. But they just get a straight interest rate. So basically, we provide them with all the due diligence materials, the approval from the lender, the analysis that we ran, and they could kind of make a decision based on that. So that's basically, how the capital stack is. So we have deep local market expertise. Like I said, I've been in this market for 27 years. The investors get passive income and risk mitigation. The selling of the property when we list it, cost efficiency. We definitely pay attention to that. We're always refining our standard operating procedures on the way we can do things to try to increase the timeline or cut expenses. But that was pretty much it. I appreciate you coming on and explaining the services. Definitely, if you guys are watching this, please reach out to CAMA. take a call with Matt and his team and see what you can do to set up an account. They're always here to help and provide the service that you need to set up your self IRA. Any closing words?
Just, I appreciate being on here, and earlier in your presentation about the emphasis placing on education. That's what we're about too. So if anyone's watching this and they feel like they just want to talk to someone about what they're trying to do, not ready to open an account or anything like that, that's totally fine. Well, we're happy to walk you through how that works and answer your questions, understand where your money's coming from. So again, thank you for the opportunity, and I look forward to talking to the people who are watching this.